We have Rakesh Arora, market expert, joining us now. The US Fed has done what was expected. They have raised interest rates, but have sounded very dovish. What would you do now? Our markets are trading at new record highs, lifetime highs. Do you think they're good for more, or do you think now suddenly the picture will change and people will realize that the US markets will continue to rally, growth will be strong there, and again emerging markets may start to underperform?
Well, see, that is the expectation, but there's a little bit of disconnect between the bond market and the equities market. Bond market is still not reflecting that kind of reflation, which can happen as compared to the hope which is there in the equities market. So my view is that equities market is not fully discounting in the risk factors and more driven by hope. So it is time to be a little bit cautious at the current levels, and people have to do more homework into where they are investing. I'm not saying that we are at top of the market. I think this rally can continue given the liquidity, etc. But one needs to be careful because we are probably entering the last leg in terms of this rally, maybe another 5-7% from here on.
You're talking for the Indian equities, right?
I'm talking about the Indian market index going up another 5-6%, probably even higher from here on. But this appears to be reaching to a level where risks are starting to dominate.
So what would you then do? I mean, if for those who missed out on this rally and they were thinking now at record highs, let's move in and start buying stocks that have a strong outlook for earnings growth, what should they do if you think it's only going to be another 5-7% higher and then perhaps a correction or a consolidation? What's in the long term for Indian equities?
Okay, so from a near-term perspective, the major drivers have been, cyclical stocks, which I would suggest that people who are already owning it might continue to hold on for another month or two because there's still some steam left out there. But new investors should start to look at, some of the underperforming sectors where expectations are not that great in terms of earnings growth, etc., like pharma, IET, consumer. So these are some of the places where new investors can start to look at.
But isn't that risky then, Rakesh? Start looking at stocks where earnings outlook is still hazy because they're cheap. What if the market's then correct? Wouldn't you be then saddled with losses?
So, the sectors that I spoke about, there's a lot of pessimism already built in their valuations. And, people are expecting, single digit to low double digit kind of earnings growth in these sectors. And I think, and these are also, I would say, under-owned at the moment. So clearly the pressure when the market turns back would be much lower. And these are the sectors where people come to hide. So, from a strategic perspective, I think getting exposure to some of these under-owned, underperforming, sectors is better, because if this market has to really move up on liquidity, bargain hunting will kick in, and people will start to look at these stocks which have underperformed and are trading at much lower valuations.
How much returns will they give? What should investors expect from them realistically if they start putting money here? They're safer bets. They may not correct as much, but will they really return reasonable amount of money?
Yeah, so see, my expectation is that, the sectors that I spoke about can deliver 15 to 20% return from the current levels. Already we are seeing some positive news flow coming in, like in case of pharma, we saw, Sun Pharma getting one of its facility approved after almost 3 years. So there's some trickle in effect coming in terms of, regulatory overhang going away. Even for IT sector, there's some news that US is relooking at H-1B visa. So that could be one of the catalysts which investors might be waiting for. And similarly, consumption names have taken a beating on account of demonetization or increased competition from, Patanjali, etc. Could be a beneficiary of GST as an organized sector, starts to feel the pressure and organized sector gains. So these are the three sectors where I think a contra bet would probably work for the next 12 months. It's too risky to buy metal names or other commodity names or cyclical names at the current level.
That sounds pretty good, Rakesh. For a low risk, getting 15 to 20% returns over the next 12 months sound very attractive. So you named for us Sun Pharma, some of the IT stocks. Any more such ideas which look like safe bets and 15 to 20% returns in 12 months?
Well, see, I can't talk stock specific, but these are the broad sectors, and the leaders in this space are all lagging behind. So maybe those are the names one can look at. Also, probably it is time to look at some of the mid caps in these sectors, given the strong funds flow we are seeing in the domestic mutual fund. Probably mid caps can outperform the large caps. So there's a lot to buy in these sectors. Most of them have massively underperformed.
Rakesh, while I understand IT and pharma have largely underperformed over the last 3 months and the markets have moved up, for consumer names, some of them have bounced back very well. They're nearly at the same levels pre-demonetization, if not at new highs. Are there still some names in the consumer space that people can make 15-20% returns in 12 months in a safe way?
So most of the large caps you see are nowhere near their previous highs. So even if they reach to that level, that's a 15-20% return. Even going beyond that, the previous 52-week high. So without naming names, it's pretty easy to find out. The large consumption names are all trading at a much lower value.
Right. Rakesh, you mentioned about the risk in the market and markets are ignoring the risk. What are these kinds of risks that you're talking about? What sort of risk? Are you talking of global risk, domestic risks?
So I'm talking about both kind of risks. The first one is a global risk. You got Brexit coming in. You got few critical elections in Europe. You have elections in China. So if you look at the consensus earnings built up for FY18, the large part of the earnings is driven by higher commodity prices, and sorry. So if China has a little bit of hiccup, if European demand falters a little bit, already we are seeing the industrial production growth globally is maturing and probably would be in a phase where it will start to come off a little bit. So the assumption that commodity prices will remain high right into FY18 is the biggest risk that I can see right now. In terms of the other risk locally, I think after this UP election win, the expectations of a sharp turnaround in Indian economy is starting to get factored in. But we don't see there's going to be any major step change. It's only going to be a gradual process. So to that extent, there's going to be a little bit of disappointment. And finally, we have GST implementation coming in from 1st July. So that is additional, uncertainty which we'll have to deal with in FY18. So all these factors, with expectations of earning at around 18-19% for FY18 and valuations at around 18 times FY18, that leaves very little, scope for any kind of disruption or risk to play out. And that's the reason I would be a little cautious here.
Right. 18 times earnings is what you mentioned. When markets fell from the 2008 highs, what was the valuation then? It was closer to 22 times. So still markets can go till that level, or because it's been 8 years, 9 years now, it's meaningless to look at those valuations.
So see, 2008 was a different kind of euphoria where the whole globe was growing and India was growing at around 9 to 10%. Currently is at 7, and that too people are doubting whether it is 7 or 6. So clearly we are not at the same economic cycle as where we were in 2008. But having said that, markets can still move up given the liquidity in the system, and that's why I said 5 to 7% up move can't be ruled out. That's why you have to stay invested. Probably change your mix towards some of these underperforming sectors probably going forward to avoid sharp meltdown if it happens in the global markets.
Have markets already started pricing in low PE stocks or buying low PE stocks? So you saw what happened with Reliance, you saw what happened with the telecom space. You think markets have already started to look at low PE ideas?
Yeah, I mean, the upside in some of those stocks which have been rallying in the last 1 year look pretty limited. And a rotation into some of the underperforming sectors and stock is bound to happen. And you're right, we already seen some shift happening, and probably this is going to get accentuated as we move into FY18.
Right. Are you surprised by the FII flows in the last few days? Do you think in the last 6 months when DIs were continuous buyers, now FIIs are getting the left out feeling?
See, this is a global phenomena that we are seeing. Flows into emerging markets have been very strong in the last 3 months. And India, being one of the better emerging markets, have attracted its fair share. So I don't think we are really surprised. But it's the continuity of these flow which is a little bit doubtful because the way US Fed rate is signaling another 2 rate hikes, and it could mean that some of the dollar would flow back into US, and the emerging markets and the risk-on trade which is currently on might not have too much of legs. So that is the risk factor. But domestic flows remain very strong, and that should support, markets, largely the mid caps that we have here in India.
Right. As far as emerging markets are concerned, when flows into emerging markets are higher than the developed markets, have you seen any trend earlier? It tends to have some sort of stickiness?
See, historically what we are seeing is that a slow and steady inflow is more sticky than sharp increases. So what we are seeing is a little bit of a sharp increase right now, and this kind of feels like a little bit of hot money chasing low valuations in emerging markets. This hot money can actually go out very fast. So I would say that the stickiness of this sharp flows is normally never seen to be very high, even historically.
Right, but if domestic flows remain sticky, and a number of fund managers have told us that now investors have adopted the SIP route, and that SIP money is very sticky. So what is the bottom for our markets? If there is what you're saying, the risk on trade goes out of favor, more flows into the dollar, emerging markets are not in favor, how much lower do you think our markets can fall?
See, given that India has been more resilient, and now we have a slightly more longer-term view on political stability, reform process, unlikely that India would drop quite significantly below the averages seen historically. So, in the next 6 months' time, people will start looking at FY19, and Indian markets are trading at around 15.5 times on FY19. So the downside is also limited to 5-7%, I would say. Indian markets are more likely to go through a time correction rather than a deep correction probably over the next 12 months. So buying on dips would be a good strategy, but probably markets will head up first before they go down.
You said that there's too much euphoria on the state elections, and perhaps some of it is misplaced on the expectation that reforms will now come in thick and fast. But there is more political stability, and that should spell out good news for reforms in the longer term. What would you like to see by way of reforms from the government? What does that do to inspire confidence in the economy and hence long-term flows?
Well, see, government has been very proactive, and they have largely delivered on most of the reforms which were expected, over the last year or so. Probably the missing link is the NPL situation in some of the public sector banks, where government need to be a little bit more proactive, because our understanding from the ground is that banks are pretty slow in resolving some of the NPA issues, and companies are not able to move forward. So once government takes more concrete steps on the NPL issue, I think that would be one of the positives which everybody is looking forward to. Apart from that, I think it is more execution on the ground rather than any kind of policy reform which is really pending. And the large orders which are given out in roads, railway, etc., we now need to see, pick up on execution on the ground, which is what would be the next key driver.
Right. So let's say that there is that dip that comes about. The risk on trade is off for some time. So when that dips happen, would you then buy those undervalued stocks which would not have corrected as much, or would you buy those growth stocks if you expect longer term reforms to be intact and implementation to steadily go ahead? Then would you, on dips, look to buy those growth related stories, or would you buy the undervalued stocks?
Well, see, India is all about growth, so I don't think there's anything called value left in India. So it is only a question of buying what is underperforming. And so when I said consumer, IT, or pharma, it's just that they've underperformed. It's not that they're off growth. All these companies are growing quite well. Even IT sector, which is coming off the charts, is still growing at high single digit. So that's a decent enough growth that investors can look forward to.
Rakesh, what about stocks in sectors like infrastructure, capital goods, power? These are also sectors that haven't really done well for the last few months. If there is visibility on reforms and if growth is also expected to pick up, would you pick names from these sectors as well?
See, infrastructure looks much better placed given that we're expecting execution to pick up. Most of the investors have been trying to play this theme through cement names, but cement names are extremely expensive, and I don't see too much of an upside there. So it is best played through some of the infrastructure names. So largely road companies is one I think which should stand out in terms of execution, getting into FY18 and should see sharp improvement in their revenue growth and profitability.
EPC names, you're talking about the EPC names there, right?
Yes, EPC names.
What about power space? What about power generators? The demand supply has been way off. They've also had issues about raw material cost and then compensatory tariffs not working their way. Any hope there in the power space? Do you think you can pick on good stocks that'll give strong returns?
See, in power space, I would say only look for companies which have PPAs in place and are earning a regulated return, because interest rates have come down and these guys are looking attractive on earnings yield basis. But apart from that, the capacity utilization for power sector is unlikely to go beyond 55-60%, even in the upcoming years. And there's very little hope that things are going to change materially for power companies. And add to that the pressure which is coming from the renewable side, meaning when you have got solar power available at less than 3 rupee per unit, I think it's very difficult to make a case for buying a coal-based or gas-based power company. So I would say that stick yourself to companies which have regulated returns on their side.
Right. Rakesh, you said you would avoid the cyclicals and they've moved up very well and there's high risk. You would avoid cement stocks because they look expensive. What are the other avoids? Would you say housing finance would be avoid because that too has moved up very well, or do you see growth still intact there? What about some of the aviation stocks that have also moved up well? Any more avoids from you?
So what I would say is that valuations are looking rich for some of the NBFCs, and people are not realizing that there will be competition coming in from traditional business houses like banks, who are seeing very anemic growth on the corporate lending, would also get very aggressive here. So margin compression for NBFCs is probably going to be the game going forward. So if some of the NBFCs which are trading at very high multiples of 5-6 times price to book, one needs to have a relook whether it's worth that much.
Right. Rakesh, you mentioned about the NPA resolution. Do you think that's the key for PSU banks to outperform?
So given the disconnect in valuations of private sector banks versus public sector bank, the key differentiation is definitely NPL issue. And if government takes concrete steps, we can have public sector banks actually outperforming. See, the story is very similar to what we saw in 2016. Metal companies were bearing the brunt, were almost loss-making. Even the best companies were, closer to bankruptcy kind of risk. and suddenly things have turned around. We are expecting similar turnaround to happen if government takes concrete steps on NPL. Public sector banks could be one of the best beneficiary in 2017.
Right, but again, in the metal packs, everything ran up because the underlying commodity did well. But in the PSU pack, one has to be very focused. It has to, if anybody is investing, one should invest into companies with very good track record, with very good, CAGR ratio that they have.
So many execution on the ground is what has been difficult for this government, and how they are able to execute for the NPL issue is also yet to be seen. So if somebody is taking a bet on NPL issue getting resolved, then it is probably safer to stick with large cap names only, rather than go all in with smaller cap names in the public sector banks. So there are only 2-3 large cap public sector banks one can actually invest right now.
Right. As far as PSU banks are concerned, there are talks of mergers. There are a lot of PSU banks right now, talks of the Mega 5 to be made. All of that, if it happens, it could reduce the cost or the OPEX for these banks quite meaningfully.
Well, see, everybody is looking at SBI to see how it plays out and what kind of impact it has on the margins. So I think that will give us a lot of guidance for the upcoming mergers, etc. in the banking space. A lot of speculation is already there, given that Kotak has to dilute its stake and there could be some mergers. But one thing is very clear, that consolidation in the banking space is bound to happen, and more so post demonetization, where technology is a big risk factor. So I think there will be a lot of activity in this space, and some of the undervalued small cap banks might play out. But that's an event risk. I would still, recommend that you stick to large cap PSU banks if you have to play that, story.
Right. As far as private banks are concerned, just because PSU banks will do well, that doesn't mean private banks will not do well. So they'll continue to grow. Maybe the growth rates are lower. That also for NBFCs.
So I'm not saying that, public sector banks will overnight go and, grow better than private sector. It's just that the private sector banks are growing at decently around 20% plus loan growth, when the system growth is 9-10%. But they are adequately valued also for that kind of growth. So the mismatch can happen when the public sector banks also start to grow a little bit faster, and they see a valuation re-rating. So it is not that public sector can pose any threat to private sector, but it is just that the expectations are lower, and valuations are also low on that account.
Last 5 years, it's been about private banks, and people have played the index story also via select private banking names. Do you think that continues to be the case? If anybody wants to play the index, cement and private banks are two sectors which continue to give that sort of comfort.
So these sectors have always found sticky investors. So I don't have any doubts whether they will be selling out anytime soon. So they'll stick on to these quality names. And it's only on the periphery that people will look to buy some of these public sector banks.
Right. The point that you made about large cap PSU banks could also be true for some of the corporate linked PSU banks, companies which have slightly higher NPAs, but their retail book is also growing.
Yeah, so everybody is focusing on retail book in absence of the corporate book. So that was the point I was trying to make, is that competition is going to increase. And to that extent, margins, etc., might go down as compared to what the street is expecting.
Right. You mentioned about IT and pharma earlier. Let's talk about these two sectors separately. So for IT, do you think buyback, the payout ratios that some of these companies are talking about, could that be a big trigger, or these are just near-term, near-term stock movers, and the focus will come on FY18 numbers?
So all these kind of dividends and buybacks obviously is something which comes to support the stock at the lower end. So that means it eliminates or reduces the risk of downside. Plus, we'll get more visibility into Q1 in terms of growth for FY18. And as budgets are fixed by the clients of IT companies. So I have a feeling that probably growth will be slightly better than what pessimistic estimates were floating around in the last few months. And with this buyback, I think it's a good recipe, low downside and a potential upside if growth is better.
Right, and for pharma, again the same story continues. More approvals from US, European markets will drive the growth. So look out for companies where base in US and Europe is low and they can get further approvals.
Yeah, so that is true. And apart from that, companies are coming out of this US FDA issue. Plus, in US they want to reduce the bill of medicines, etc., which augurs well for Indian generic companies. So overall, I think situation can turn around for Indian pharma companies as US FDA approvals start to kick in for their facilities here.
Rakesh, just a last word on the market. So you said that markets can go up 5 to 7%. At what level on downside would you be comfortable? Say if markets from 9150, at what level on Nifty would you be comfortable buying?
So, comfortable level is actually 15 times FY18. That is where you think that the downside is limited. We are currently at around 18 times.
So assuming there are no change in the earnings, what is that number?
So assuming there's no, consensus building around 18-19% earnings growth into FY18. And after that, the market is trading at around 18 times. So it's quite richly valued, meaning 15 times I would have said blindly go and buy. So, but that's 20% lower from here on.
Right.
So, but that's not the level we are looking forward to. I think market might probably correct at the max 4-5% from here. Because expectations after the UP election of a sustained reform process and a good governance is what is going to keep it up.
Thank you so much, Rakesh, for taking out time for us. Always good to get a perspective from you. That was a view from Rakesh Arora saying that markets will look cheap at 15 times, but that's not what is expected, at least in the near term.